Hey everyone, I wanted to quickly update you on something that we made a really big deal about in the fourth quarter and a bit even a bit before then of 2020, so last year. And that is what we thought was an important call where we thought that we were going to see the broader S&P 500 starting to underperform the equally weighted version of the S&P. So basically what that means that we thought and we still think we're basically maybe just at the beginning of this is that the average stock is going to outperform the few heavily weighted mega cap, some of them are tech names. And so I want to give you a bit of an update. And so as of right now here today is, March 4th, we have a situation where the broader S&P 500, and this is just today, but so far this year is up about 1.7.8% or so for the year. The equally weighted is up more like 7.5 to 7% year to date. Now, again, near-term gyrations can happen, but let's flip to the charts, and I want to show you kind of where we are in this and what it looks like. So just looking at the aesthetics of your simple market cap weighted S&P 500, you can see it basically has reached your long-term resistance lines. And again, this is just a technical look on it, but it gives you an idea of kind of what it looks like visually. It's kind of you can draw the lines 1,000 different ways, but to me this is kind of stretched. Now, if you look at the RSP, which is the equally weighted S&P 500. I'm going to make this a weekly chart. What you can see is that we really have a situation where, and by the way, we might be a bit short-term overbought here, but the equally weighted S&P has really only started to break out of a base in November 2020. And we think there's more to go with, certainly in relative terms. To give you an idea on this, let's understand what the market cap weighted S&P is heavily weighted on. It's heavily weighted on a few tech stocks and a couple of consumer discretionary stocks like an Amazon. But if you look at underneath the surface at, for example, industrial stocks, which essentially have been basing for the better part of the past 2 years, they recently just started breaking out. And when I say recently, it's a couple months ago at this point, a few months ago at this point. But we think there's more to go there. Energy stocks, which have been nothing but crap for many, many years now, we think they're essentially just basing here and could go a lot higher. How about financial stocks, the XLF? This is really juicy, and I'm going to make this a monthly chart because that's how long the base has been. We have financial stocks, which are an important part of the market, but they don't pull as much in the market cap weighted ETF as they do in the equal weighted ETF of the S&P. And you can see they are literally just starting to break out here over the past month or so. So this is an important point we're trying to make. We still think it's better to be along the equally weighted S&P 500. The ticker symbol, by the way, is RSP for that. I'm going to quickly bring it up here again so you can see this. Again, RSP is the ETF. Again, the call isn't necessarily that you have to be long the ETF as it is to be long the average stock, which, for lack of a better term, means you don't necessarily want to be long Apple and Tesla as much as you want to be long energy stocks, financial stocks, industrial stocks, as we are seeing rotation, part of it being somewhat higher interest rates. So I hope this is helpful, folks. Give us a thumbs up, like, or comment down below, and we'll see you soon.